and prices will just keep going higher and higher and higher, which will further disincentivize refiners to produce gold and silver, which will make the supply that is available for selling even lower and make the backwardation even more extreme. This will lead to the end of the dollar system at some point soon. Now, Keith does not believe that gold to silver ratio will reach 15 to 1, whereas I do. I don't know how long it's going to be there, but I do think it is going to happen. Keith thinks that the conditions that allowed for 15 to 1 ratio back then do not apply now. I don't know exactly what he means, but I'm going to try to make my case that gold and silver permanent backwardation will necessarily lead to a 15 to 1 ratio. How long? I don't know, but I think is going to happen. Here are the slides, and this is my case.
In today's news recap, silver price soars past $60 for new record. Silver notched another record high on Tuesday as the precious metal continues to attract bids amid concerns over a market deficit. Spot silver rose as much as 3.6% to a new peak of $60.46 per ounce, keeping the momentum of a record-breaking rally that has lasted nearly 2 months. Driving this surge was a supply crunch caused by a historic squeeze that hit the London market in October. While that concern has eased in recent weeks, global supply remains tight, with Chinese inventories now hovering at their lowest in a decade. What do you think, you guys? Are you buying even more at these record prices? Also, behind the move was the expectation of a U.S. interest rate cut this week, which would be positive for safe haven assets such as gold and, by extension, silver. The white metal is getting a bid this morning alongside gold ahead of the Federal Reserve meeting, with the market pricing in near certainty of a 25 basis point cut, said Trevor Yates, a senior investment analyst at Global X ETFs. Silver first surpassed its October peak in a choppy trading session as a chaotic halt on the COMEX exchange in late November dried out liquidity. The holiday season and low physical trading in London's over-the-counter market also amplified price moves. Tuesday's rally takes silver past the $60 an ounce mark for the first time ever. The metal has now doubled in value this year, even surpassing the 60% gain seen in gold. Now smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
The Wall Street Journal, and 2 paragraphs or 2 sentences from that article, which are key. Japan is outspending. Bond markets seem nervous about picking up the tab. Japan's prime minister plans to rely on bonds for the $135 billion stimulus package. Yoshihiko Noda, leader of the opposition Constitutional Democratic Party of Japan, said in a parliamentary session that markets are raising an alarm against reckless fiscal spending, including this latest economic package. He warned that Japan could face a crisis similar to the Truss moment in the UK in 2022, caused by then Prime Minister Liz Truss's plan for big tax cuts, which led to a sudden spike in gilt yields and a plunge in the pound. Well, we've seen Japan's 10-year yield rising pretty relentlessly over the last few weeks. You can see here, this I added in at the bottom. This is not part of the article. This is a graph from Trading Economics that shows the long-term chart of the 10-year Japanese government bond yield. We are at 1.965, and you can see this is the final resistance level going back all the way to the Asian financial crisis of 1998. And above this resistance level, there is space. Outer space, and that's a technical term for outer space, I guess.
Space, the final frontier.
Space, the final frontier.
In the 90s, we saw that the Japanese government bond yield went from about 8% all the way down to where it is now at 2%. So once we break this yield, this resistance, rather.
Resistance is futile.
Yields could go pretty much anywhere between 2 and 8 pretty quickly. And we all know, what does this have to do with gold and silver backwardation? Well, we know that central banks are so full of debt because they buy their own government's debt. And that's what we mean when we say that fiat currencies, which are not exactly fiat, they are really gold and silver currencies with a whole bunch of debt inflation on top of them. When the debt goes away because the value of debt is falling, because the yields are rising, that's when gold and silver reassert themselves as monetary commodities, primarily gold. But then what happens when the value of the bonds backing the money falls because yields are rising? Well, gold becomes too expensive. And that's why the public says, well, I can't get any gold. What I can do is maybe sell my labor for some silver. And that's why silver's price rises relative to gold when these bonds fall in value and eventually reach zero because the currencies that they are payable in become worthless. Let's go to the next slide. This is a very similar article that came out in Bloomberg today. QE may be needed if market queries new Fed chair Man Group says. What's the Man Group? It's a group of man. I don't know, but it's pretty big, I guess. The Federal Reserve may have to turn to quantitative easing to lower long-term borrowing costs if bond markets start to question the independence of the next chairman, according to Man Group. Really, it has nothing to do with the next chairman. All it has to do with is the fact that they have stopped QE, and that is not good for the banking system because they trade trillions of dollars in quantitative easing dollars every day in the repo market. But let's go to the second paragraph here. Investors only have to look at what happened in the UK. Look at that again. They're using the same analogy. When traders sold off gilts in 2022 due to a lack of confidence in the economic policy of then Prime Minister Liz Truss.
In today's news recap, is Bitcoin really digital gold? In 2025, the leading crypto has failed to answer that question. Bitcoin's sharp pullback from its recent record high wiped out its year-to-date gains, and that's led to questions about aggressive price targets for the cryptocurrency into 2026. But as important as where Bitcoin's price goes next is a question about the role Bitcoin really serves in a portfolio. When will it consistently behave like a store of value? It's still going to have to prove itself as that digital store value over a longer period of time. Nate Geraci, Novadias Wealth Management president, said on the CNBC ETF Edge podcast. For years, Bitcoin has been described as digital gold, a comparison that can be powerful and appealing to investors since gold is expected to protect portfolios during periods of broader market stress, moving in a manner uncorrelated to stocks and other risk assets. But for Bitcoin, the digital gold narrative is undermined whenever it trades like a risk asset during equity sell-offs. After two distinct periods of volatility in 2025, Bitcoin hasn't been able to provide a clear answer to the digital gold question. The track record thus far is mixed, Geraci said. He pointed to the tariff tantrum period of stock selling in April after President Trump announced sweeping global tariffs, a period of market volatility during which Bitcoin performed very well. That caught a lot of investors' attention, he said. But more recently, as weakness in technology stocks led the market down, most cryptocurrencies, including Bitcoin, also sold off. Bitcoin in particular sold off considerably more than the stock market, he noted. Now, smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
Christina Hooper, chief market strategist at the world's largest publicly traded hedge fund group. And I guess the world's largest publicly traded hedge fund group is Man Group. It's kind of ironic that the head of Man Group is Christina Hooper, who is the chief market strategist, who is probably not a man, but these days you never really know. Now, the point is you have two articles, one from the Wall Street Journal, one from Bloomberg, saying that bond markets are about to have a Liz Truss moment, where what happened in the UK at that time was that gilt yields skyrocketed because the bond market was losing confidence in the ability of the UK to pay back its debt. Which is what cued the Bank of England at that time to buy a whole bunch of bonds. And they're saying this could happen both in the Fed and in Japan because the bond markets are not going to want to fund all this spending. So the central banks are going to have to pick up the tab. And of course, that is going to lead to massive consumer price inflation as we start the final money printing round. Now, here's my thesis. Once we start this final money printing round, which is already being hinted by the Wall Street Journal and by Bloomberg, what happens next is that silver starts to break out. So this is the short-term, relatively short-term trend line of the gold to silver ratio. You can see here I drew a trend line from the 2011 bottom at 30 to 1. I wrote about this at the Endgame Investor on Substack. Check the link in the description below if you want earlier reports on this stuff and more written form, and actually better because I'm a better writer than I am a podcaster, whatever this thing is. So we see here 2011 30 to 1 level, and we have a trend line that was established back in 2021 and hit again in 2024, and finally it was broken just I think it was 2 weeks ago, and now we are at 72.18 gold to silver ratio. So this trend line has been broken, and we could head much lower, and I think we will head much lower in the gold to silver ratio. Maybe we'll have to retest this trend line from the bottom as resistance instead of support, and then we will head down towards 30 again. How fast? I don't know exactly, but here is the long-term chart that shows that the gold to silver ratio has hit 15 to 1 3 times in the modern era before. We're talking about the Federal Reserve era, I guess. This is the pre-modern era, you could say, where the gold to silver ratio was around 15 to 1 straight from about 1718 to about 1880. Right? This is 1873. This is when the dollar went off the silver standard, and that is when the silver started falling in value. The falling silver value is shown by the rising blue line in this chart, but we did hit 15 to 1 3 separate times. Once in 1919, at the end of 1919, right after World War I. That was because of a monetary inflation of World War I. Also in 1968, at the fall of the London gold pool, and in 1980. It's not just 1980. It happened 3 times. And you can see here there's like this imaginary line that this cannot go through, because this really is the natural monetary ratio of 15 to 1. Why is it exactly that? I don't know exactly why it's 15 to 1 or 16 to 1 or whatever it is, but that's what it is, and that's what it has always been. Not always, but most of the time for recorded economic human history.
Do you agree with him? Are you still bullish in gold and silver? Is a massive collapse going to happen in 2026? Post in the comment section down below your honest opinion. Subscribe if you have not yet done so, and watch this video right here because it's a perfect fit for you. I'll see you on the other side.